Okay, that seems to be everything kicked up and alive for now, so that's good. So I think it's well worth looking at the figure later to see how thin it gets and show you how much time, because obviously when I sit here and I said if non-farms comes out, you know, higher, what do bonds do, and it's kind of like you have a little think, oh yeah, they go lower. It'd be worth you seeing how thin this market gets and how damn quick it moves, and you know how we can try and compete or realise that there's no way to actually compete over the figure, and find new ways of obviously jumping in and out. So we've got about 7 minutes before I'll pop the ladders over. So we left it in terms of talking about our opens and about our decision making process, and we were talking about our different types of open, which is good. That's what we need to be talking about. So if we open in value, there's two things the market can obviously do. They can either accept that we're in value, or they can reject that we're in value. If we open in value and accept, then it means that the market is in balance, sentiment is unchanged, which means also that we're waiting for something to happen. We're either waiting for an initiative trader or something to come in and move us, or a figure or a fundamental announcement, anything like that, because at the moment the market is in balance and sentiment is unchanged. The risk on that day is low. The trading risk is low. The market is unlikely to move. Unfortunately, with lower risk comes much lower opportunity. The day's range will usually be contained to the prior days or a similar size with a slight overlapping. Confidence in one area of support or resistance can be used to predict the day's opposite high or low. Now, I've seen this technique used quite a lot.
Looking at some of the consensus numbers for the non-farm payroll itself, the headline figure.
I have seen this technique used a lot, whereby the market structure and the market is in balance, and you can almost visualise how you expect the market to pan out. So for example, if you know that the range in the Bund is 30 ticks, and you've opened in value, and you have opened, and the market is accepting that, so it starts to balance within value, you can normally make a good guess that the next day's range that you're trading within will either be contained fully within that range, leading you to have an inside type day, or alternatively, if one side is maybe just slightly more dominant, so an area of support or resistance works quite well from the open, then you can kind of predict a 50 tick lower range. So it's like a summation or a guess as to where the range is likely to be, and so long as the market is in balance and accepting that, you can forward think it. It's a bit like there are times when I will sort of think about an area of support or resistance where I think the 50% might go to, or the 50% might shift to, or how would it look so that it will perfectly balanced, and you can start to get a guesstimation in advance as to where you think the highs and lows are likely to be. If we open in value and we reject, then the market is driving out of balance early in trade. Again, this is all about the open. So this is all very early indications of market balance. And if we drive out of that balance early, either into a new value area or a new set of highs and lows, then we are rejecting the next day's balance point, the prior day's balance point. And so your risk and opportunity is slightly better because your market is shifting out of balance. If we open out of value but still within range, then again we have two choices. We either accept or reject. If we accept, then we're not quite as balanced as if we were opening in value in range, but we're still okay, we're still comfortable. So again, the market range is likely to be similar but slightly more biased in the direction with which we've opened, either below or above value. Bias is to the side of the value we have moved above or below. So we accept the fact that we've opened out of value, but at least we've opened within range. So again, range prediction procedures apply. If we open out of value but in range, and we reject, if we break out beyond the extreme of the prior day's range, i.e. the high or the low, we are moving out of balance and risk and opportunity are high. So if we open out of range fully, we again have two choices. We can either accept that we're out of range and the market is out of balance, so we will either continue to drive in the direction of the breakout, or we will auction back and forth at these new levels as we accept these new areas of balance. The range potential is unlimited if we drive further, and a trend day will usually result if we drive in that direction. If we open out of range and we reject, then we reject the open out of the range and we break back into the prior day's value area. The potential for a strong move back into and through the prior value is set in motion, and the range is unlimited. So there's lots of different areas that we can open, and this is all about the opens, and I think what we'll do is we'll take a sweep through all of these again to make sure that we get it, because those first 17 slides were all about the open. Now we have got 2 minutes to the figure, so let me move some of these markets across. Don't worry, I've changed everything to 0 so I don't do something particularly stupid. So that's the Bund, that's our S&P, and that is our Euro. So let me just lengthen these up. And try and recenter them. The center button on this is really, really sticky. It's annoying. There we go. Okay, so boom. Bund at the moment, with 3 minutes to go to the figure, we are pretty thin. We are flicking around, we're trading 91.92. The S&P is trading 52 and a quarter. And our Euro is trading 65. So we've got 2 minutes to the figure. Don't forget our expectation is 175.
90 seconds per data.
So you want
starting with the headline month-long payrolls number. Then we'll move on to the earnings and employment and income tax through in more detail.
So remember, higher number, lower bonds. Higher number, higher FX. Higher number, no idea in the equities. but I suspect a blip up followed by a move lower. I used to repeat that mantra to my head all the time: higher, lower, lower, higher, higher, lower, lower, higher. So I drummed it into myself, knowing where to hit. The euro's going off the screen already. Notice that, just had a move up in the euro. All very thin. Notice how everybody has pulled their orders, turned their algorithms off. 20 seconds. There's nothing in here. There's gaps here. There's gaps here. We're 6 lots up now. 4 lots up.
$156,156, earnings 0.2% in line, unemployment 5% above the 4.9 expected. The non-farm payroll
S&P going up on it, bonds crept up a bit.
167 from 151. Private payrolls coming at 167, just below the 170 expected. Unemployment was 5% above the 4.9. Earnings in line at 0.2%. Hours 34.4 in line. Participation rate 62.9% to 10th above last month. The Canadian employment plus 67.
Note how that euro's flicking around, how quick this market is, a lot quicker than the bunds.
23,000 pounds, up 44,000 in Canada. So again, the non-farm payrolls came in around 19,000 below the consensus number. But last month was revised higher by 16,000. The unemployment rate 5% above the 4.9 expected. Bear in mind, participation rate was up by 10 versus last month as well, and in line with expectations. Canadian employment did beat.
I mean, I think that's still actually strong enough for a sell-off in the bunds. I know it's missed expectation, but I do actually think that that's probably still quite enough near consensus and far enough away from sort of Yellen's target number that I think that could still get sold into. So you know how thin it went, how volatile these markets get. Got pretty thin, didn't it? Emptied out. I mean, the algos have come back in fairly quick. Paper came in, we saw paper came in, there was a 500 lot who chased it. But it's very, very quick. You know, as soon as that number comes out, that ladder starts flying around the place. Very, very quick stuff. I wouldn't be surprised to see the bonds sell off now.
Because they went up, then they went back down again, didn't they?
Yeah, now they've come back again. They're actually the point of control. If you just see on the just off to the side here, that's our bund.
Oh, okay.
So they are actually now, they've shifted point of control that little bit higher again. It's been quite an interesting dogfight in that bunds today, actually. But yeah, busy stuff. Okay, let me shut this down. Alright, So, back to our opens. We're going to run through it all again, quite quickly, but we'll run through it all again. So, there are 4 types of open. The open drive, the open test drive, the open rejection reverse, and the open auction. We know that the open drive is our strongest. It indicates a high or a low at the open. And most of the time we should never trade back at that open price. An open test drives are initiative in nature. They take a little bit more time. We open, we test beyond a known reference point to get some confidence, and then we reverse quickly through the open and drive in the opposite direction. We are unlikely to trade back at the open, and we normally look for, again, a normal variation or a trend day. These are the least common in nature in terms of open drives and open test drives. We've understood the concept of markets having to test areas before they actually go the correct way. They're, in a sense, this is what we often call stop hunts. This is why people say no stop goes untouched, because the market needs to break to rally or rally to break. An open rejection reverse occurs when the market opens, it trades in one direction, is met with a strong response enough to auction us back through the opening range. We mustn't get confused with an open test drive at this point, because whilst it might turn into something more, usually it's a less convicted directional profile that occurs. The probability of a trend day becomes low, so we look for normal days or normal variation days or neutral days. An open auction, the one that we see the most of, looks like there is no conviction at all. Price auctions above and below the opening range, and it occurs, an open auction that occurs within yesterday's value area needs to be treated differently to one outside of yesterday's value area. A market that auctions within is likely to be a non-conviction day. A market that opens outside of the prior day's value area is somewhat different. So we get the open auction in range. It lacks conviction, typically auctions within the previous day's range, testing support and resistance. It typically pays to fade the extremes on days like this. When you don't see a lot of convicted buying or selling, and we open inside the prior day's range, expect the market to auction. It will search for direction all day. Higher prices and lower prices drawing in participation. Non-trend, normal or neutral days are likely. We wait for the market to establish its extremes, and we buy below value and sell above value. Within the open auction, if we open auction out of range, this is a market that is out of balance. There is a lot more potential for a dramatic move in either direction than an open auction in range, because the market is already out of balance. The trader needs to be on guard because it could develop into a larger move. It starts looking like it has no conviction, yet because we are out of range, we know we are out of balance. There is a greater chance direction will become apparent than had we have opened within range. The days merge across profiles. One day and its outcome is not forgotten by the market the next day. Markets that are out of balance have a greater range potential. There are 3 outcomes based on the previous day's range and today's opening that we must accept. If we open in the prior day's value area, we accept this or we reject this. If we open in range but out of value, we either accept or reject this. And again, if we open out of range, we accept or reject it. So if we open in value and accept the market is in balance, we are looking for ranges that are usually contained in the prior days or have a similar size with a slight overlap. Confidence in one area of support or resistance can be used to predict the day's opposite high or low. If we open in value and reject, then the market will move out of balance early in trade to reject the prior day's balance point, and we are looking for a bigger range. If we open out of value but in range, then again we accept, which is a part meaning that we are in balance, but not as balanced as if we were in range in value. Market range is still likely to be similar, but slightly more biased. The bias will be to the side of value we have moved above or below. If we open out of value but in range again and we reject, we are breaking out of the and beyond the extreme of the prior day's range. We are moving out of balance and risk and opportunity are somewhat higher. If we open out of range and we accept this, then the market is still out of balance. We will either continue to drive in the direction of the new breakout, or we will auction back and forth at new levels as we begin to accept balance. Range potential here is unlimited if we drive further. A trend day is usually the result. If we open out of range and reject, then we are moving back into the prior day's value area. The potential for a strong move back into and through the prior value is set in motion, and our range is unlimited. So this is all about your open and your initial balance, and everything that you've got to go through is all about trying to understand the market context. What is the most likely outcome that we are going to achieve? If we're out of range, then we've got instantly the potential for bigger ranges. Trend day, a drive in one direction, or a more aggressive P-shaped or B-shaped profile. If we open auction in range, then there's less chance. So it's all about understanding, putting together not only all of these types of opens. Was it an open test drive? Was it an open rejection reverse? We've got to put all of that into context, but we also have to put it in terms of where are we opening? Are we opening in value, out of range? So do we have an open in the prior day's value area combined with an open test drive? Or have we got an open out of range, but we've actually got an open auction? And we put all of these together, we put them together in our mind and in our head, and we start to understand the probability of where this market is likely to travel. In terms of further discussion and further things that are in the book, obviously that takes us, that's a lot of reading, that's a lot of stuff to go through, and absolutely by no means am I expecting that you're going to remember all of these. Half the time it's difficult enough for me to remember all these things, let alone you guys. But it's important to know that you almost want to get a graph going, you almost want to get some form of cheat sheet so that there are 6 types or 4 types of market open. One of those can be categorized into another type of open, and then in that we need to correlate it with where we're opening in the market, and then we can start to surmise and start to understand and start to predict where this market is likely to travel to. What is its range potential? Markets have different range potentials. we also talk a lot about time frames when it comes to market profile and the type of market that we're in and the type of market that we're trading within as the day develops. So we've got the building that's starting to sort of come to understanding. So we've begun to understand about day types and how many different day types there might be. We've begun to understand how the size of our initial balance can give us an early indication as to what day type we're going to be in. And now we understand that an hour after the open, we can start to pinpoint even further what type of day we're likely to be in and how we can project the range.
The payrolls are a solid number. Mr. now speaking live on CNBC.
So as the day progresses, we talk about time frames and who's in control. This is a little bit like when we're talking about our TPO counts. We're trying to assess who is in control. When only one participant, i.e. a buyer or seller, is in control, we call it a one time frame market. When neither party is in full control, we call this a two time frame market. In a two time frame market, there is a lack of conviction. A one time frame market, one participant gains control. So how do we identify who is in control?
Mr. says she does not think the best behind the curve yet, but monetary policy does have to be forward looking.
We get indications as to who is in control of this market throughout the day. We've already discussed our TPOs as a way of assessing who is in control. We also get tails and extremes, which are the most clear indicators. So if you recall, a tail would be that one set of single prints, as it were, at the bottom of the profile or at the top of the profile. That's what we call our tail. The longer the tail, the greater the conviction. So when we look here,
Fed is apolitical and asked about the potential to hike in November given the upcoming elections.
this is our Euros. Actually, I'm not going to do the Eurostocks. This is our Bund. So today we've got a tail here. It's only 3 prices. It's quite a smaller tail. It's not got as much conviction behind it as this. So this is a big tail. A tail with more TPOs on it indicates more conviction behind it. So when we talk about tails and trying to identify who is in control, today we would look at this, and again, although we seem to have fallen into a bit of a B print balance type day, we can still see that from the open the sellers are still a little bit more convicted than the buyers. So tails is one very clear indication. Another way that we can identify who is in control is range extension. So successively higher or lower auctions. These are probably much easier to see on a candlestick, in my opinion, because obviously your profile bunches up together, so you don't always see instinctively that you've auctioned higher or you've auctioned lower. But successively higher or lower auctions is a way of identifying who is in control. If we extend our range to the upside over numerous 30-minute time frames, then the buyer is obviously exerting control. If we are extending our range to the downside, so successively lower lows, then the seller is obviously exerting control. The less time a market spends trading a price also indicates the less acceptance of that price. Markets moving quickly through a price indicate a strong presence there, so it will usually serve as good support or resistance later. That's why we pay an awful lot of attention to selling tails or buying tails or single prints. The more time you spend at a price, the greater acceptance of that price, and that's when you get your high points of control or your high volume points of control, and that is your fair value, your fair price. However, what we do have to understand is that too much time at a price will eventually mean that we have to move away from it. So during the day, we need to be aware of when maybe we've spent too much time somewhere, and that point of control is likely to shift. During the day, we do often maneuver between different time frames. So we will often go from a 2 time frame market when we're balancing and buyers and sellers are fighting, and then one wins and we enter a 1 time frame market and we move out. So this can happen around fundamental news or figures, as we've just seen, and then we'll go back to a 2 time frame market. You'll often see that on double distribution days. So if there is no transition at all, and either 1 time frame is in charge all day, that would be a trend day. If it's 2 time frame all day, that would be a normal day. A 1 time frame to a 2 time frame means that we are probing prices beyond a known reference point. It does not attract any new participants, so we return back to a 2 time frame market. A 2 time frame to a 1 time frame means that the ranging market has broken through an area, or fundamental news shifts us from balance to imbalance. So the importance of auction failures, and this is not auctions as in something that we've yet to discuss and yet to come up against. This is about price discovery, price auctioning. A follow-through is the answer to the question we posed earlier. How good a job is the market doing of going in the direction that it is attempting to go in? Without follow-through, then it is failing. When we auction above or below a known reference point, one of 2 things will happen. We continue to move in that direction as new business comes in, or we fail. A failure often results in a speedy move back in the opposite direction with a lot of conviction. The reason for this is that the market has probed that new area. It's no longer scared of that new area. When we were talking about we've got to, rally to break or break to rally. So if we auction higher and we fail, then the conviction behind the move back the other way is greater, because we've seen one half of the equation. The magnitude can vary depending on the importance of the reference point we have broken, i.e. whether it's a daily level, a weekly level, a news point, or any of those more significant areas other than just an area of support and resistance. So this is where novice traders make the biggest mistake, I think. They take that first loss using the main reference point, and then they cry like babies. Okay, they don't understand what has happened. I often talk about it in terms of a tuition fee. You have paid a price to get a high degree of conviction as to what will happen next. You should not be crying over that first trade, but you use the knowledge to fuel your next one. So if you have sold, for example, double O's and you've got a stop at 05, and they then get stopped out at a major reference point, they take their trade, they've identified the reference point, but they then get stopped out, they then sit there with their head in their hands. Oh, I can't believe I've taken a loss. They don't understand the next move, because as it comes back down through where they sold and they got stopped out at the high, they're still moaning about the last trade, but they're saying, how did I get stopped out? Why did I get stopped out? How did I get it so wrong? And they're not understanding the significance. And the significance is that they've either auctioned and it's failed on the break, so they should have more conviction to get back into the trade, or it's gone through their reference point and it's continued to auction and they're still moaning about the trade rather than understanding what has happened to the market. So every single time frame, every single action that the market takes has got a major significance behind it. It's not just doing it for fun. If it auctions above a reference point and fails and then comes back, that's telling you something. If it auctions above there and incites new business, it's also telling you something. Whether you take a loss on trading that reference point or not, it still tells you something about the market. So I do, the importance of understanding auction failures above, without the follow through, the market is failing. How good a job is the market doing in going in that direction? They're the questions you always need to be asking. Right, I think that's a good point to stop as we head into the importance of shifting VPOCs and POCs. We've got plenty more slides to get through, so I'm going to flick on to the other screen now and just run a very quick stream and a discussion of the figures that we have seen, and then we'll be back on here just after 2 o'clock to finish off our week. So I will speak to everyone in 5 minutes on the other side and then back here shortly after that. If you need a break or anything, now is a good chance. Speak to you in a bit.